Thank you. I'm very happy to present this paper here. This is a joint work with Xiaoyun Yu at Indiana University. And I will talk about corporate finance benefits of short-term investors, and I'm really aware that when I say this, to somebody this may sound like an oxymoron. So what I want to start with a sentence from The Economist saying that, I'm well aware that there is a large body of research that has so far been stressing the cost of short-termism. But there are also signs that there is anecdotal evidence that would push us to change a bit our mind. And for instance, Ron Gilson sent me a very nice paper just last week that I enjoyed reading. So what I want to stress with this statement that I took from The Economist is that, is not that I want to say short-termism is good, long-termism is bad. It is a matter of nuances, and what I will do in this paper is to look for some states of the world in which, having a short horizon can be better for firms' long-term performance. And the background that I have in mind is that, economies and firms nowadays are subject to many shocks. The economic literature has been focusing mostly on the effect of import competitions on the competitive advantage of firms. And these shocks require some sort of industry restructuring. Of course, there will be some winners and losers, but in the current economic literature, we tend to say that, if there is an increase in import competition from China, firms have a drop in their sales, they cut employment, and what we think, what future research should ask is what are the characteristics of firms that allow them to emerge as winners. And in this particular paper, we focus on a feature of ownership structure. And in particular, since we will focus on our data from the US, we will look at heterogeneity in institutional ownership. So we will look at firms that have relatively more short-term investors. So let me spend 1 second to say what are short-term and long-term investors. Typically when we think of long-horizon investors, these are firm investors that do fundamental analysis, buy a chunk of stocks in a firm, and they keep them for many months or years. A characteristics of long-horizon investors is that they are either index funds or they have a very concentrated portfolio. They are less diversified than investors that trade a lot. So these two characteristics of the portfolio of long-term investors imply that long-term investors cannot sell as easily as short-term investors. So that is, as investors that trade on the basis of the order flows, they want to make high returns over the next quarter, and that, if they see some signal of negative shocks or underperformance, they sell en masse. Okay? So that's what we conjecture in this paper is that, firms with more short-term investors are faster in adapting to radical change. And the reason that why we think this occurs is that, well, short-term investors are known to sell to create a financial market run if there is underperformance, if they fear poor returns. Therefore, this creates some pressure on managers, and managers might be faster in taking action that will change the firm competitive advantage and adapt the business of the firm to the new environment. So what I want to stress here is that when we think about the investors affecting a company, well, we think of voice, we think of exit, of the investors actually walking out. But something that is potentially even more important is that managers know that these investors might walk out, and they want to avoid that this happen. They want to avoid the drop in share prices that this would cause. So in order to have a causal mechanism that goes from short-term ownership to firm performance, we not necessarily have to observe some big events, an activist campaign, or some en masse sales, because the pressure is there, especially when we don't see anything. There is a nice working paper of Fosse-Kahn that makes precisely this game theoretical point. So in the paper, we have a very, very simple model just to make the point that what we look at is not at odds with the theoretical framework on which all the literature on short-term investor is based. That is Stein 1989 model. There, well, managers that are that cater to short-term investors would take suboptimal action to signal their type to the market and to benefit from short-term price increases. Okay, so we can think of our mechanism in that framework if we add some state of the world. So there are some state of the world in which the short-term action that is requested by the short-term investors is actually congruent with the firm objective to maximize long-term performance. So empirically, we go to the data and we try to identify these states of the world in which the short-term action is actually expected to be more beneficial. And in all the results that I will show you during this presentation, I will basically base the empirical analysis on trade shocks that follow large tariff cuts. And we know from the economic literature that these are significant negative shocks for firms that have to cut employment and sales. And these shocks have been used in finance as negative shocks to competition. However, my main empirical evidence will therefore be for manufacturing industries. All what I will tell you, however, also works for a different shock, that is the deregulation of the service industries that Alexander used in a JP paper. So what do we actually do? Well, we take firms that differ in their ex-ante institutional ownership, and then we explore empirically how they react to these large tariff cuts. So this is not exactly a difference-indifference model. It is a sort of a difference-indifference models in which we look for firms' differential response. What are our findings? Well, we find that following a large increases in competitive pressure due to large tariff cuts, firms that have more short-term institutional ownership before predetermined tend to cut their sales and employment less. They invest more. They do more diversifying acquisition, they differentiate their product, and overall, they have better long-term performance. That is, their Tobin Q and their profitability remain higher for the following 5 years. The paper has already a long list of tables because, of course, there are the usual identification concerns, but we find no evidence of, for instance, differences in pre-existing trend. We try to control for endogeneity of institutional ownership the best we can. I will try to show you these empirical tests later on in my presentation. So data, the data are very standard. So it's Compustat, 13F, and the international trade data everybody else used. So what is short-term versus long-term institutional ownership? In previous literature, these are concepts that are widely used, and they are typically defined on the basis of an individual investor portfolio turnover. So we say that a particular institutional investor he has a shorter horizon than another if this institutional investor has higher portfolio turnover. My empirical analysis, however, is not at the institutional investor level. I care about the firm level investor horizon. So what do? Well, we aggregate the proxy for investor horizon at the firm level using the investor's the investor shares in the firm. In practice, or what I will show you is based on two proxies of investor horizon. One is that we simply use the definition of transient investor by Bouchy, and the other one is a measure of portfolio turnover that I have also used in previous work. So this is the initial preliminary evidence. So first of all the time I present this paper, people ask, oh, do you actually notice that these large tariff cuts are bad for firm performance? And this table shows you, yes, this is the case. Is following a large tariff cut, on average, employment, sales, and investment for firms affected in that particular industry drop. What you see here is that we also try to have an initial exploration for the timing of the change. And what we see is that the main difference in initial reaction between firms is in the year immediately following the tariff cut. Is in the year immediately following the tariff cut that firms with more short horizon investors cut employment to a lower extent and keep relatively higher sales. But firms with long-term investors never catch up. So then we move to our empirical analysis, and on the basis of this preliminary evidence, I will first look for differences in initial reaction in the year immediately after the tariff cut. Then I will look at the permanent effect on firm performance, that is, Tobin's Q and ROA, and then I will hopefully have some time to talk about the mechanism. So what do we find? Well, we find that following the tariff cut, the firms that have a one standard deviation higher short-term institutional ownership tend to cut their sales by 10% less than other firms. So they maintain larger market share. What can go wrong with the identification here? Well, consider that in all these regressions, we are controlling for the direct effect of institutional ownership. So the question is whether these short-term investors are selecting different firms before the tariff cut. And hopefully I will get there. The results on employment are similar. So then we look at long-term performance. What is the question here? Well, we know from the work of John Grayman, Harvey, that firms with short-term investors like to window dress. They do earning management and so on. So maintaining a higher employment, going out on advertising campaign might be a way to window dress for their investors. How do we try to test this hypothesis? Well, we can look at long-term valuation, long-term profitability, and what we find is that, well, it looks like that the top in queue of firms with relatively more short-term investors remain higher even 5 years after the tariff cut. So these it looks like that their effects are positive and permanent. So how do they achieve this? Well, in the paper, we provide evidence that this firm try to maintain or create a new comparative advantage. They don't do more acquisition, but they try to enter new industries. They do more diversifying acquisition. And they invest more in R&D and advertising. Possibly, as a consequence of these changes, we observe that in the years immediately after the tariff cut, these firms' product differentiation increases. And we use Gordon Phillips' measure to look at product differentiation. We also find that following the large tariff cuts, these firms experience a higher CEO turnover. So it looks like that they try to adapt the executive team to the new environment. So let me spend the last few minutes talking about the robustness and the identification concern that we could have. So one question is, so all the results I've shown you hold within industry. So I am looking for heterogeneity of firms with different institutional ownership within an industry that has experienced a tariff cut. So these results are robust if I include interaction of industry and year fixed effect. But the concern could be that firms with more short-term institutional ownership behave a bit differently than the others within the industry, even before the tariff cut. So we perform a placebo test considering a placebo tariff cut that is 1 year before the actual tariff cut, but we don't find anything. So this suggests that there is no pre-existing trend. The other issue is that, well, short-term investors are institutional shareholders that have to pick good firms. So they might be particularly good at picking stocks. This is a concern for me if they are very good after the tariff cut, because otherwise I have the direct effect of short-term institutional ownership already controlling for that effect. So what do we do to mitigate this concern? So we do 2 different tests. One is we use the decimalization event to construct instruments. We say that the decimalization of stock trade might have increased the liquidity, especially in smaller firms. So we use these as an exogenous variation in short-term institutional ownership, and we perform instrumental variable estimates. Our results are robust. Another test that we do that is less sophisticated, we just say, firms with short-term investors always cater with short-term investors. The short-term investors clearly change, but they tend to have short-term investors also 5 years before. So we lag short-term institutional ownership by 4 years, and we continue to find our funding. And then we look for other mechanisms, but I am out of time. So let me conclude saying that, well, perhaps we don't want to increase the cost for short-term investors, because this might be costly if there are large shocks and we want to have some firm restructuring and avoid zombie firm problems. Thank you.
So this paper is dealing with a very big question in our profession, and the issue is that stock markets and joint stock companies are the two basic institutions of capitalism, but they don't live together their coexistence is somewhat problematic. Is problematic theoretically and problematic practically. So theoretically, some of the biggest most important foundational papers in our profession, like Grossman-Stiglitz or Grossman-Hart, deal with the problematic coexistence of these two institutions, and obviously policy-wise. So I think the world has understood it in first time after the bubble, the South Sea bubble in 1720. And the reaction by Parliament in London was to ban the creation of joint stock companies. The law existed for 100, it was repealed only in 1825, so it was on the books for 105 years. I know that legal historians still debate what exactly the law said, but clearly it reflected some a very strong feeling about this phenomenon of short-term holdings as somehow conflicting with the notion of ownership. So ownership has to be real, and real means not too many owners and for a long period of time. So obviously this is a very big topic, and on which empirical evidence is a bit scarce. And here comes this paper and tries to narrow somewhat the gap. And the main finding is that companies with short-term investors respond better to negative shocks. Okay, that's the basic findings, and clearly it is an important findings. So let me go over a few points that I think deserve a little bit of elaboration. The first is the shock, which is a cut in tariffs. The shock is being identified by the actual amount of tariffs that companies pay. I was wondering what is what is going on in the data, namely, are these changes in tariffs a result of a few big trade deals that the US was making? If so, which are they? What was the size of the cut? Also, perhaps it will be sharper if a sharper experiment and a cleaner experiment if you just focus on the trade deal rather than the changes that you measure that might reflect also composition effects. Also, another thing that the reader is kind of, or I was interested to know, if indeed the shocks are coming from trade deals, how long did it take to negotiate the trade deals? What was the period between approving ratifying the deal and implementing the deal? When exactly prices reacted? Was it anticipated? Not all these things. I think. At least I wanted to know a bit more about what's going on in the data. So these are some of the descriptive statistics. Institutional investors have, on average, a 35% stake. Short-term investors have a smaller stake, on average 10%. Standard deviation, there's a typo in your table. You say 1%, but it's 10%. It must be 10%. I would like, again, to have some more information. What is the typical block size? What is the typical duration of the holding? What type of institution is it? Is it a hedge fund? Is it a pension fund? An activist fund, and so on. So as a reader, I just wanted to know more about your sample. So again, going back to the main result, right after the tariff cut, performance falls sharply for all companies, and you measure it by sales, employment, assets, and Tobin Qs and ROA. But the effect is moderated by short-term institutional investors. And certain policies are correlated with the short-term investors. What worried me was this assumption that you make on page 14, where you say our empirical approach thus allows us to identify the causal impact of short-term institutional investors on firm performance, etc. As long, here starts the difficult part, as long as short-term institutional investors are not particularly good in selecting firms that they expect to perform in the comparison to the other firms following the negative shock. So the basic assumption is that somehow the allocation of short-term institutional investors over these companies is random. Now, for the sake of not being too opinionated about this assumption, I would like to cite the authors themselves and what they say about short-term institutional investors in the introductions. So these are all citations from your introduction. Short-term institutional investors have an advantage in acquiring information. If they have an advantage in acquiring information, then evidently their presence as owner is not random. Long-term investor might not be able to sell fast, and that means that short-term investors do have this capacity, and that is some characteristic of the firm that attracts the short-term institutional investors. Long-term investors are passive, short-terms are not. So again, they would be attracted to companies where they can be active. Quite a long list. I mean, I can go on in things that you believe, and I think most people believe about short-term institutional investors that will be in contrast to the point that you make here. So Again, one finding that you mentioned in the presentation is the following. There is no evidence that short-term institutional ownership decreases following the tariff cut. If anything, short-term institutional ownership increases. So that, again, indicates that there is a trading reaction, only that it comes after the trade cut. And that is related, to interpret this better, I would like to know, again, what was anticipated and when exactly the information was released. Is it that they do buy after the prices fall and then they try to do something in order to improve the performance? So obviously, I understand that this is a reaction to this hysteria about identification, which is possessing the profession. But I think it's an overreaction. And not only that, it's not terribly convenient, it's not necessary, because you could do with the data so much more than what you avoid doing because of these concerns about identifications. So I think that the questions that we all want to know and your data is capable of answering is the following. Conditional on firms' characteristic, what trades are being executed by short-term and long-term investors? Is it really the case that there are no change in position of the long-terms? And is it the case that short-term are buying, or perhaps they are selling? That would be a very strong evidence to the mechanism that you have in mind. Is it the case that in some companies they realize that they can't do anything, or that they failed in achieving what they wanted to do, and they left and the price dropped, and so on, and so forth? And that would be very much in. Okay, so do they buy? Do they sell? Then what conditional on the trades? What kind of actions did they take? And then conditional on the actions that they take, what was the outcome in terms of performance? So your data is so much richer than I think there are so many more opportunities in the data that can be exploited. And you know, there are ways to deal with these kind of endogeneity. There are perfectly kosher ways to deal with the endogeneity by taking the predetermined as instrument. I think that you are just missing some of the action that is going on in the data. So again, just to summarize, conditional on characteristic, what are the trade? Conditional on the trade, what is the action? The steps that are being taken. Conditional on the steps that are being taken, what is the conditional effect on the restructuring? Two more small questions, slightly about presentation. I would narrow down the exposition to those things that you really find in the data. So you have an interesting idea in the introduction, and this is that short-term institutional investors are triggering activism in some way, but perhaps they do it excessively. Perhaps they do too much, or they push the companies in which they are present to do too much restructuring. This is an interesting idea, but there are no evidence. So I would just clean the paper of things which, I mean, there are many interesting ideas, but if they don't have support in the data, I think it makes the paper a bit difficult to read. Another thing that I would try to be a bit more precise is this. You use in the paper short-term and short horizon interchangeably. And that, I think, is a bit misleading. Short-termism is a trading strategy. Basically, it's measured in terms of how long traders are staying in a company. Short horizon is something else. It's more of an equilibrium property of the model, namely to what extent the short-term horizons are failing to internalize the long-term value. And that depends on whether the price at which they sell reflect future prospect or not. So again, there's more in the discussion or in the language of the paper than what the data actually shows. So in terms of presentation, I would sharpen these points.
Thank you. Questions on the paper? Merritt?
I guess I just like to push a little on the question of, which firms short-term investors are attracted to. I assume, what their skills are they're good at gathering information and analyzing it in terms of, quote, making prices more accurate or anticipating what's going to happen with prices, which one assumes is incorporating information into prices. And which firms I assume they're going to select firms where they think those skills are going to be most valuable. And so I'm wondering what the characteristics of that kind of firm is, and then how that might relate to the possibility that there are two different kinds of management that's good under continuity and management that's good in periods of change.
We can gather questions and then I guess get a response. McCarthy?
Yeah, just to follow up on that, I mean, maybe on Merritt's point about these characteristics, if you have a propensity analysis, which the types of shareholders that are likely to be attracted on these broad range of or narrow range of characteristics, it might be a little bit more purposeful in that sense. That would be my sense, because it's difficult in the sorting otherwise.
I've done a bad job of making people have the microphone. I'll wait for the microphone.
So could I start to answer some questions? Could I start to answer? Perfect. Because I think this is... so thanks a lot for the comment, Oren. I think on this thing of the horizons, short-term, short horizons, we use them interchangeably in our 2013 RFS. We might have messed up the literature on the because we have over 200 sites. So, but now let me get on the two main points that also are recurring here about this thing of the identification. Okay. So the sentence that Oren put there, it was I would stress the words. Particularly so. So our identification assumption when we use ordinary least squares is that these large tariff cuts are an event like any others. So short-term, as long as short-term investors are good at stock picking after that event as in other time, we should be fine. Of course, that is because there is the direct effect of short-term institutional ownership. If I always take the best performer in an industry and I don't do so to a larger extent after this shock, I'm fine. Okay. Said that, we also were concerned about that because, of course, that is a large informational event, and that might be the situation in which there are more trading opportunity. And for this reason, we use the desimilization event, that is companies whose liquidity has increased differentially thanks to decimalization, have an increase in short-term institutional ownership that we argue is exogenous, okay? Because it's given by the regulation. And so in that test that we currently present as a robustness test, our results go through both qualitatively and quantitatively, so we are not very concerned about that. But this also brings me to answer to your question, that is this issue of what kind of firms are these. So short-term institutional investors like liquid companies because, well, they collect information, but they want to use the information soon, and they want to sell, okay? And that is what we use also in our instrument. Now, if you think that liquidity shouldn't matter for the competitive advantage of these companies once that there is a tariff cut, we should be more or less okay. Okay, so there is another issue that I want to reply, Oren, is the issue of the timing of. So it is true that these trade deals are negotiated for a lot of time, and actually I think that would be interesting to look at more at the dynamic effect. Said that, the reason why we follow this approach is that, of course, there is a large literature on the effect of import penetrations on firm performance. So import from China, large tariff cuts as we use, and so on. And everybody so far seems to look at what happened afterwards, and the reason seems to be that there is generally uncertainty on who will export more and who will be, which firms will be the more direct competitors. But I agree that our data are very rich and we can do more.
How?
Thank you. I happened to see these people before when your co-author was presenting in Singapore, and I had a question I still have that in terms of understanding the incentives of those short-term investors. So do they really know what they are doing? So if they know what they are doing is actually helping the firm to be more resilient to the shocks, then in some sense they are not short-term, right? They actually, what they are doing help the firm in the long run. If they don't know what they are doing, they are just really transient investors. And then what you document is more like an unintended consequence of transit trading, right?
The thing is that you care for the short term because you are selling in the short term. That might help the company in the long term, so it might be good for the economy. But in general, when I think of your profit maximization, you think of your own back and how much you keep the company in your portfolio. So.
I think somebody in the back.
Okay, I sort of a conceptual question. I wasn't quite clear. First, what is the potential friction you have in mind which can lead to a conflict between the long term and the short term, or more than one potentially? And given that, what are the implications? Sort of traditionally would think short-term investor, that is basically the government's mechanism we rely on is the exit threat, and where the long-term guys were the voice guys. So when they're saying the exit threat is better than the voice for whatever reason. And also, secondly, I always thought about the exit threat is the threat of selling is going to kick in. But these guys are actually selling. So when...
Okay, so the issue is the following, is that, as I said before, they always sell, but the question is when they sell in mass and create a financial market run as in Bernardo and Welsh. And they create a financial market run if they all go to sell and they don't sell to the next short-term investors. Now, I don't see necessarily a conflict between short-term and long-term, but I see a friction for the long-term that having a more concentrated portfolio, they hold a lot of the stocks of those companies, or being index investors, they just cannot sell as fast as the short-term investors. So the threat of selling en masse is stronger for short-term investors. So it's like in my paper with Andrew, we see that there is a shock. Lehman, they just selling mass because they know that in the short term, the returns will be negative. So if they see signs of short-term underperformance, they may sell in mass, and the management wants to avoid that. The long-term guys, they cannot do it. That's
A question up front.
Thank you for the important implication to Japanese economy. I think already there are a lot of event studies that show the short-termism have a negative effect in U.S. companies in the long run. But as far as I know, we have no such a statistical study in Japan on Japanese companies, and also anecdotally, most Japanese people feel no such short-term pressure or short-term problems, and many Japanese companies struggle not to change. So definitely, your implication is very plausible. We may need to have more short-term shareholders in Japan. But my question is, although I understand you choose the tariff cut deregulation as an event for the statistical study, in practice, I think the technology change, disruptive innovation is more important shock for the many companies to need to change. So how is your statistical studies implication to those disruptive innovation? Let me show a couple of anecdotal case. Say Kodak bankrupt.
yeah.
But the Fuji film successfully changed their product from film to pharmaceutical. I guess the Kodak had more short-term shareholders rather than Fujifilm. I'm not sure, but possibly. And also, I know several cases of Japanese family farms to successfully change their business model just after the big technological change. Evidently, the founding families are typical long-term shareholders. So how could you explain these relationships?
So I think in principle, I would say this has to apply also to disruptive technological change, but it's very hard to go beyond the anecdotes. So I don't know how to measure it. If you were to have ideas, I am very happy. Now, I think that this issue of the family firms is very interesting, and I think that deserves to be independently analyzed. So I would have the same intuition as you. I am looking at institutional ownership and trade. I have been looking in a very preliminary descriptive evidence at European firms and what these kind of trade shocks can have on European firms. And actually, the data confirm your intuition. I don't know why, okay? But what I have to say now is about institutional ownership of different types. So.
I think we have time for one more question. I saw a hand up over there.
Thank you very much. One thought on channels. At first, when I saw that you used decimalization, I thought, wait a minute, but this is also about liquidity, and doesn't liquidity lead to other things? But then I thought maybe that's exactly the channels through which the short-term ownership operates. So it's not that I happen to have short-term ownership, but I am a firm that attracts short-term owners, and that makes me more liquid. And first, that means that for everybody else, it's also easier to exit, and therefore the exit threat, even by long-term investors, is more credible. And then second, liquidity makes it easier to raise funds, which means if I restructure now, I know that after the crisis, it will be easier for me to raise funds to build up things again. Whereas if I'm more illiquid, I would be reluctant to restructure too much because I'm afraid that I won't be able to do it again.
Mm-hmm. So I think the way in which we think of liquidity is that more liquid firms attract more short-term investors. So that's there is evidence about that. I do not think so. Besides the channel of equity issues, I'm not sure there is much evidence about that in this context, but we can for sure look at this. I don't see any other possible effect of liquidity than the one of making the threat of exit more tangible. And I might not have conveyed it in the most clear way, but that is precisely the channel that we think is in the data. There is no evidence that short-term, very diversified investors become active investors. It's just, the economics of the institutional investor wouldn't add up for them to be the active shareholders. The channel is through trading and is through the exit and the en masse exit in particular.